Health insurance, which helps pay for prescription drugs and dental coverage, is a form of living benefits insurance. Other living benefits insurances covered in the accident and sickness module include critical illness, disability, and long-term care. There are two main ways to share costs with an insurance company for health coverage. Coinsurance, a percentage of the bill paid by the insurance company. For example, with a 70% coinsurance plan on a $1,000 dental bill, the insurance company pays $700, 70%, and the client pays $300, 30%. This cost split applies to every dollar spent up to an annual maximum. The maximum resets every calendar year on January 1st. Deductibles, a fixed dollar amount that the client pays first before the insurance company covers the rest. For a $1,000 dental bill with a $250 deductible, the client pays the first $250, and the insurance company pays the remaining $750. A client can have a plan with both a deductible and coinsurance. In this case, the deductible is always applied first, and the coinsurance is applied second to the remaining balance. For example, with a $1,000 dental bill and a plan that has both a $250 deductible and 70% coinsurance, the client first pays the $250 deductible. The remaining $750 is then split according to the coinsurance, with the insurance company paying 70% and the client paying 30%. A policy with both a deductible and coinsurance is cheaper per month because it offers less coverage. Generally, more coverage costs more money per month. Group health insurance. Group insurance, often called benefits, involves a third-party contract between the workplace, the insurance company, and the employee. If the employee leaves their job, the contract ends, and they leave their health plan. There are two key time periods for group benefits. Probationary period, the amount of time an employee must work before becoming eligible for benefits, e.g., 3 or 6 months. Eligibility period, a 30-day window after an employee is offered benefits to either accept or decline them. If they do not accept within this period, they typically cannot join the plan later. With group benefits, there is no medical qualification process, and everyone on the plan pays the same price regardless of age, gender, smoking status, or health. This is why the eligibility period is limited, to encourage enrollment when healthy, not just when sick. The tax implications of group health insurance depend on who pays the premium and who receives the benefit. Employee pays, employee receives. If the employee pays the premiums, e.g., via salary deductions, and receives the benefits, there is no tax deduction or taxable benefit. Workplace pays, employee receives. If the workplace pays the premiums and the employee receives the benefits, the workplace can claim the premium cost as a tax deduction. The employee, in turn, must declare the premium amount as a taxable benefit on their income. The amount of the tax deduction for the employer and the taxable benefit for the employee will always be the same. Split premiums. If the employee and workplace each pay a portion of the premium, the employee only pays taxes on the portion the company paid. Health insurance riders. Riders are optional add-ons that customize a policy, making the coverage better but also increasing the cost. Riders must be added when the policy is first purchased. Two riders mentioned for health insurance are accidental death and dismemberment. AD&D. This rider pays out if the insured dies or loses a limb due to an accident within 365 days of the accident. It is not recommended because the payout is conditional on the cause and timing of death, unlike life insurance which covers death for any reason. Travel insurance. This is a medical-only travel insurance rider that covers expenses if the policyholder gets sick or injured while traveling. It does not cover trip cancellations or lost baggage. Critical illness insurance. Critical illness, CI, insurance pays a one-time lump sum if the policyholder gets a life-threatening illness. There are two main types of policies, a 4-illness version and a 25-illness version. The 4 illnesses are stroke, heart attack, life-threatening cancer, coronary artery bypass. A 25-illness policy is more expensive because it offers more coverage. The 4 core illnesses account for over 85% of all critical illness claims. Critical illness policies have 2 time periods. Qualification period, a 30-day period from the purchase date during which the policyholder is not covered. This prevents coverage for pre-existing conditions. Survival period, the policyholder must survive for a specified time, minimum of 30 days, but can be longer, after being diagnosed with a critical illness to receive the payout. A longer survival period results in a cheaper policy. Factors that affect the cost of a critical illness policy include age, smoking status, health, and gender. Women typically pay more for living benefits insurance, while men pay more for life insurance, which is based on statistics of who claims more often. Family history also plays a significant role in critical illness underwriting. A common rider for critical illness policies is the return of premium, ROP. With this rider, if the policyholder doesn't get sick by the time the policy expires, e.g., at age 65, they receive some of their premiums back. This is a good option for clients who don't want to pay for something and get nothing in return. Disability insurance. Disability insurance provides a monthly payout while someone is unable to work. The payout stops if the individual returns to work. Coverage is limited to a maximum of 60% of an individual's gross income to provide a monetary incentive to return to the workforce. Factors that affect disability policy ratings in addition to age, gender, and health include occupation and past disabilities. There are 3 types of disability policies, ranging from least to most expensive. Cancelable. The insurance company can cancel the policy or raise the price at any time. Guaranteed renewable. The insurance company can raise the price, but cannot cancel the policy. Non-cancelable. The insurance company cannot make any changes, including raising the price or canceling the policy. There are also 3 definitions of disability that determine the payout when someone changes jobs due to an injury. Any occupation. The policy will not pay if the individual is capable of doing any other job, regardless of whether they are currently working or not. Regular occupation. The policy pays a portion of the benefit if the individual is working a new job that earns them less money than their previous job. Own occupation. The policy pays the full benefit as long as the person cannot perform their original job, regardless of how much they earn in another profession. This is typically for professionals like surgeons, doctors, or dentists. Disability riders. Some riders for disability insurance include return of premium. ROP returns some of the premiums paid if the policyholder doesn't become disabled. Accidental death and dismemberment. AD&D pays out if the policyholder dies or loses a limb due to an accident within 365 days of the event. Presumptive disability pays a monthly amount if the policyholder becomes blind, deaf, or loses a limb, assuming they are unable to work as a result. Cost of living adjustment. COLA provides a percentage increase in coverage each year without new medical underwriting, suitable for salaried employees. Future purchase option. FPO allows the policyholder to increase their coverage in a lump sum without new medical underwriting, ideal for self-employed individuals or business owners. Partial disability pays 50% of the policy's benefit if the policyholder can only work part-time due to a partial disability. Residual disability payout is based on the percentage of income lost due to a partial disability. If a person's income drops by a certain percentage, their policy pays out that same percentage of their policy benefit. Business-based disability policies. These policies are purchased by and pay benefits to a business, not an individual. Business overhead expense. BOE covers a business's rent, utilities, and employee salaries if a self-employed business owner becomes disabled. This policy helps the business stay afloat but does not pay the owner an income. Key person insurance pays the business for losses incurred when a crucial employee, the key person, becomes disabled. It does not pay the key person directly. Buyout insurance provides a lump sum to buy out a disabled business partner. There are 2 types. Crisscross. Partners buy policies on each other. Share redemption. The corporation buys the policies on the partners. The key difference is who owns the policy and receives the payout. Long-term care insurance. Long-term care, LTC, insurance is designed for the elderly or incapacitated. It covers both physical and cognitive disabilities and is a reimbursement plan for costs associated with caring for someone who can't care for themselves. A person qualifies for a payout if they are unable to perform 2 or more of the following activities of daily living: ADLs dressing, eating, toileting, bathing, and mobility, not transportation.